Okay, alright.
I think so. The two other co-founders that started the company with me, they are actually the entrepreneurs. I'm not the entrepreneur of the group, I would say. So the idea generated when Brijesh and Victor, my fellow co-founders, they were crashing at my place in Delhi. So they were doing they're doing another startup of their own. I was in a corporate. I was working as a consultant on the finance side. Uh, but every day after work, I think everyone used to get together. And since the startup stories are far more exciting than the corporate stories, so all the discussions centered around, I think, what Victor and Brijesh were doing, what else they could do, and what we can build together. Maybe something which will be impactful and could be something big in the future. So I think out of those discussions, what we uh, shortlisted was that we needed around 2 to 3 things from our startup. One was it should be a problem that we closely identify with. So all three founders are born and brought up in Bhubaneswar. So we grew up together in a typical middle class family. And as you know, in middle class families, what we typically feel is that education is the thing that the entire family's focus is on. And I think that was the core principle that we shared, all three of us together, that we believe that education is something that can have a huge impact on anyone's life. So this was a problem we really identified with. Second thing, we wanted to do something which can be very big. We felt that the financing ecosystem is something in India where the credit penetration is very low. There is a huge scope for good financing companies to come into picture and solve for the accessibility problem. So we felt that something in finance, and the three of us also had experience in finance domain. So I myself worked as a consultant and an investment banker. Victor was an investment banker, and Brijesh was working with a risk management team at HSBC. So all three of us had some finance background, so this synced with what we could do or what we could achieve, and it could be really big in a country like India where the penetration is low, as I mentioned. The third thing we wanted to do was to have a huge impact on the way we are doing business. So if you are doing a credit business in India, since the penetration is low, there is always a scope to build a big company without actually trying to impact the lives of people, let's say, who are lower down the rung or who have low income, who have low income in their families. But we wanted to build a product which can ensure accessibility of finance to the low income groups as well, and help them take education decisions which better their lives going forward. So these three things we wanted to achieve, and that's how the entire Propelld journey started. And the brainchild, I would say, it came out of the discussions between the three of us. I think no one can own to the core idea. I would say all three of us have similar ownership on it. Uh, to talk about the journey, it was quite a difficult journey for us. Uh, the core principle was that the three of us, we had some experience in finance, but we did not have much experience in retail lending products. And in the finance ecosystem, the grayer your hair, I think the easier it is for you to grow in this line. But it was not so with us. So it was quite difficult to start things off. We initially what we did was we started off with a peer-to-peer lending platform. At that point of time, RBI had not come up with the regulations for peer-to-peer lending platforms, and we felt that this is a way in which we could start lending, because it was very difficult for us to convince banks and lenders to trust us and deploy capital through a platform like us with three co-founders who have no experience in the industry. But in peer-to-peer lending, we could convince a couple of HNIs to start lending to the people that we are able to get on board. Uh, so that was the point. But RBI, I think in December of 2017, they came up with a guideline saying that for P2P platforms, you need to be registered with RBI and you need to have certain capitalization in the company. At that point of time, we did not have access to that minimum capital that was required. So we could not continue with that model. So we shifted to a model in which we partnered with financial players like banks and NBFCs to lend through our platform. Uh, like I said, that when we started up initially, there was no buy-in from the lender side. But since in the P2P model, we had given out some loans, 100, 150 loans, and we had shown some repayment, the smaller lenders were ready to try us out. And that's when we partnered with one lending partner and started our journey. On the other front, we did not want to just be a lender in the education domain. The entire model that we wanted to build was had three objectives primarily. One was that it had to be a model which was capital efficient because of the lack of I think we found it difficult to raise capital in the market at all times. So it was we needed the model which was capital efficient in nature. The second thing we wanted to do was we wanted to prove that education loan portfolio can be a good portfolio if managed well. So for that, we needed to have a very sharp focus on the NPAs or the bad loan quality in our books. So we needed to ensure that our NPAs were below somewhere around 1.1% level in the education domain. That was not the experience that big lenders had in that segment. Education loan portfolios typically had very large NPA numbers for majority of the public banks or private banks that were active in that segment. So we needed to prove that a quality loan book can be created out of it. And for that, we needed to have a very sharp focus on the credit and the collections bit of things. The third thing we wanted to do was to control the risk or the service quality of the education institutes in a way. We fundamentally believe that education is a service that is being provided by the service provider to the customer. And the service is not easily definable, I would say. That you cannot define whether a person is going to like the course, whether the institute is going to deliver on the promises that it has made to the customers. And if that service quality is not maintained, customers in a way will feel cheated, and it is understandable. In India, education is a very emotional decision. So if they have certain expectations out of a course that they are taking for their children, and it is not getting met by the institute, people are going to have a very, I would say, bad repayment behavior. Like they would feel cheated and they would not want to repay the money that they have taken as a loan for the course that they have taken for. So we needed some sort of buy-in from the education institutes to ensure that the service quality of the institutes are being maintained or the promises that they are making to the customers are being met. In that way, so that is how the three core concepts fit in. We have a very B2B2C model where we tie up with an education institute. We understand the type of customers that they are catering to, the type of courses they are providing, what sort of promises they are making to the customer, like what are the deliverables going to be, and if let's say any of the deliverables are not being met by the institute to the customer, what recourse does do the customers have against that particular institute. So all this thing, to ensure all this, we needed to have a model in which institutes are behaving like a partner with us, not like a way of sourcing loans. They are actually partners who help us build that loan portfolio. Uh, so all our technology, everything had to be ensured that it is built towards ensuring that the institutes are a partner. They have some dashboards, they have some systems in which they can see how the loans are behaving. Like, are there anything where the customer is stuck at, they need some support? Can they provide that support in conjunction with Propelld? When they are paying back, let's say a course is running and a loan is also running, if they are facing any problem with the course, what can be done to ensure that the customers do not feel cheated and such things. So all those interactions between the education institutes and us as a platform had to be built. So that was the key thing that I think differentiates us from the rest of the players. We treat it as an ecosystem where each participant has to play their own part to grow the thing. So that's where we started. That was the model, and we started with a lending partner. The growth has been good for us, I would say, in the last 2 to 3 years since we went on with a model where we are partnering with RBI registered NBFCs and financial players. I think in the first year we disbursed somewhere around 26 crores of loan, or we funded around 2,600 students. To last year where we did around 410 crores of disbursement through the platform. So we funded almost around 40,000 students. Currently, if I look at it, we would have serviced at least around 1,20,000 or 1,30,000 students, out of which around 60,000 to 70,000 students will have currently loan outstanding through the platform with our partner NBHS. So the growth has been good, and we have stuck to our basics that we needed to have something which is capital efficient, that we are able to generate our own positive cash flows. We are not dependent on external funding. Second thing, we have built a good portfolio quality where we are ensuring that our NPAs are well under control and lenders feel that this is a good quality portfolio to which they should have exposure to. That actually brings down the lending rates for the entire ecosystem as well. If they start feeling this is a good portfolio, then the cost for the customers also start coming down. Third thing is treating institutes as a partner rather than just a lead sourcing agents. So we have a lot of processes which are ingrained with the institutes, which help us in controlling the NPAs as well as keeping our costs down, and also building some sort of moats in the industry, which prevents other players from coming in. So Propelld is a platform which ties up with education institutes to provide customized financing products for the customers that are coming to the institute. So if you have to draw a parallel, it would be like what Bajaj Finserv did with the consumer durable markets. Like when you step into a Chroma store or a Reliance Digital store, there will be, when you're buying a TV, there are certain financing options that are being provided to you. It will be mostly a zero cost financing options where Bajaj has tied up with Chroma and Reliance to ensure that easy financing options can be provided to the customers. So we have a similar model in education institutes. So we started off our journey where we tied up with the online players first. That was an ecosystem where we had some connects within the founders, so we could start our journey there. And the online space was growing quite rapidly when we started Propelld. So that was the point where we tied up with online course providers. When I say online course providers, there are typically two types of course providers. One are the professional certification online degrees course provider, the likes of Upgrad, Great Learning, and such players. Then online K-12, the likes of Vedantu, An Academy, Whitehart, Byju's, and such players who are catering to students who are from KG to 12 and test preparation and such objects. So this was the segment where we started our journey in, where we tied up with the education institutes and provided financing options to the students that are taking up courses. In most of these institutes, it will be typically a zero cost financing product that is being provided, where the interest costs are being borne by the education institute themselves, so that it can offer very low cost financing to the customers that are coming there. That was the space that we started off in. Then after that, we have started moving into the offline space as well. Till now, online is still a very small portion of the overall education ecosystem. So I think only around 3 to 4% of the overall education spend will be going towards the online space, I would say. So offline, we again started off in a space which was very similar to what we did in the online space. So we wanted to start up in a space where the space we started off in was the test preparation market, the likes of JE preparation, NET, banking, and all such players. The ticket size that was typically there synced well with what we did in the online space. The 10 years, the type of loan products that work there will be very similar to what we did. So that was the space we started off in. So now we are doing quite a bit of volumes in our offline space, the likes of Akash, Allen, and such players in the JE and NET space. And we are also moving more deeper into that ecosystem. So that is how we are going there. On the other aspects, the two big markets that we have started entering are the higher education, the colleges and degrees, like people taking the BTech, MBA degrees, where we are providing financing at the college when people are going for admissions. That is one thing we have started off recently. And the second thing, the schools market. That is something that is still in the experimentation phase, where we're trying to figure out what sort of products can work there. So this is how we have grown in that education ecosystem. We behave like a fintech player right now. So we have a model in which we have RBI registered NBFCs, quite big entities who have almost 10 to $15 billion in assets. So we have big lenders at our backend who are providing the final loan to the customers. We don't take anything on our books right now. So that is how we have functioned. We take care of the entire platform where we are ensuring that the institutes and the customers are given a web platform where they can easily apply for a loan application, track it, and then providing that set of information to the lender so that they can book a loan into the system and ensuring that they are able to provide the loan to the end customer. So we coordinate the entire process between the lenders and the customers that want a loan. So that is how we have built it up. Digital payments, I think that adds a very good efficiency factor to the entire process. Because of the digital payments coming into play, the likes of eNACH and such solutions being approved by NPCI and being implemented at a very fast pace, the collection effort that really goes into collecting money back from the customer, that really goes down. Like there are auto debit options and all that can be implemented, and it brings down the cost of collections, I would say, and it ensures that we are able to give to a more wider audience. And so that is one thing that has really helped. The digital, if you also mean digital lending guidelines, so they have ensured that, I would say that with RBI coming up with the digital lending guidelines, which will govern how fintechs function, I think that is a welcome change from RBI. RBI started to take note that, okay, there are fintechs who are enabling lending in the ecosystem, and they are coming up with steps which ensure that all the parties, different parties involved in that entire ecosystem are protected. I think that is a very welcome change, and we should adhere to the steps that have been laid down by RBI, saying that this is how you should function. And I think there will be a couple of more iterations that are going to come to the digital lending guidelines that RBI has come up with. I think we are waiting for them so that it becomes very clear about how or what our role is going to be in the entire ecosystem. So that is something we are building towards, and we are looking forward to seeing what RBI comes up with next, I would say. And about the youth part, how it affects the youth, like you asked. So the type of financing solutions that we are providing actually enables customers to take more optimized education decision. Like let's say, for example, you don't have access to capital. Let's say you have to pay 50,000 to 1 lakh rupees for a course right now. That may be difficult for you to arrange based on the type of income that you are earning. Let's say you are earning 20 to 25,000. Taking out 1.5 lakhs makes it difficult for you to take that decision. But when the financing solutions coming into play, What it basically means is that some of these decisions can be preponed. Like if you are thinking that, okay, I will take it when I have access to more capital, that those can be preponed to now. So you can take up your education decisions faster. And also, if you are thinking of taking a cheaper course, which may have been suboptimal for you, you may think of taking a more expensive, more suitable course. And since the financing options enables you to pay it over the course of let's say 1 year or 2 years, you can obviously take out some money over your future earning to pay for that. So all these two things are going to ensure that there are more optimized education decisions are being taken by customers. And there is, and we can also see that in uh, the growth that online professional skilling and certification players have seen in the ecosystem. So more and more players, more and more customers or students are opting for uh, how do I say, more tailor-made education courses, like very short-term, like specific to data science, digital marketing, AI, ML, and such courses. They're becoming quite a bit of gaining quite a bit of popularity, and the growth that we have seen in the institutions catering to that has also seen an uptick. So I think things are going in the right direction, where people are understanding that there is a need for upskilling and they need to invest in themselves a lot to ensure that they are relevant in the entire employment ecosystem. Definitely. So actually, the COVID period was a welcome boon for us, I would say. At that point of time, there was a huge rush of people towards the online providers, and they were our key partners at that point of time. So the growth that we saw from the online providers was quite large, like more customers opting to take up more courses or opting for courses to act as supplementary to the offline courses that they were taking up. So the growth was quite phenomenal during that time. On the other side of things, there was a lot of NPAs in most of the lending portfolios during that time, which came up because of the lower earning ability of the customers that had taken loans and such things, or their decisions getting postponed to a later time. So all such things led to a very high NPAs across portfolio for most of the lenders in the ecosystem. Uh, so that actually resulted in many of these horizontal lending players taking a step back during that time, even though the education portfolio was not doing bad. So they were cutting down on their exposures across the segment, and education segment was also a segment there where their exposures were getting cut down. I think that gave us the opportunity to go and replace, not replace them, to actually take up some of the market share that we could not capture before that. And since then, we have not looked back. I think the education institutes also realize that this is a long-term partner, will always be there through the thick and thin. And so we built very good relationships with the institutions. And since then, the growth has been phenomenal for us. That is on the growth side of things. On the investor side, yes. So the capital dried up really. And since all the lending players were facing such a big problem in their portfolio quality and collections and growth as well, the investor mindset was not to invest in any companies that are there in the lending. I would say very few companies would have got funded during that time. Uh, for us, what it meant was that since we had raised a very small capital round before that, 2018, I think 2018 end, we had raised a capital round. And we needed to survive during the COVID period. So what it ensured was that all of us were driven towards ensuring efficiency because external capital was not going to come in. So we needed to figure out a way in which we could survive. So we needed to generate enough cash flows from our businesses to ensure that we are able to survive through that period. So that actually helped us in focusing the attention of the entire founder group into ensuring that we are becoming a cash positive business. I think by the time the COVID period was over, we were a cash positive business at that point of time, at a very low asset size also. Uh, so that was a welcome change for us. So we raised a capital round in March of this year, but that was after we became a cash positive business which could run on its own at a 20-25% year on year growth. I think we were generating enough cash flows at that point of time. With the new capital coming in, what it has allowed us to do basically is to go into segments where we could not go into since we did not have access to capital, specifically the offline, which required a large investment in the infrastructure and everything, sales infrastructure, collection infrastructure, and which we did not have at that point of time. But we have started gaining access to those markets once we had access to capital. So I think the COVID, in a way, for us was a boon. It helped us mark our presence in the education domain. Like we were a player which will exist in that domain. Second thing was it helped us prioritize what are things that are important to us in the right way, saying that we needed to generate enough cash to exist. So these two things I think was a positive for us. I think the motivation factor was we wanted to build something big and build something impactful. I think that was the goal which always kept us going throughout our journey. Uh, I think the other thing is that the three founders, all three of us are school friends. Like our parents know each other, we have grown up together. So there is a great deal of bonding that goes in. So when the three of us come together, no matter the ups and downs, we feel that we can sustain through that. And the three of us also have very different personalities, which complement each other, I would say, in a good way. Like we can have fights, we can have huge fights over what needs to be done and all, but the next day everyone will be back to normal, saying, okay, let's go to a chart place and have chart and just discuss it out. I think that has really helped us. It has helped us helped keep us grounded. Uh, we are comfortable in discussing everything with each other. We are also ready to accept what our faults are and what our strengths are. So we have a clear picture of what that is. If someone also misses that, the others are very quick to remind him or her about what his strengths and weaknesses are. So these three things put together has ensured that we are able to go through our journey apart from the vision that we had set for ourselves, I would say. Um, the challenges, I think, the major challenge that we faced always was lack of capital. I think I can understand the reason for that. Three of us had very limited experience in the industry, so it was difficult to convince either the lenders or the financial institutions or the investors that we would be able to do a good job out of the capital that you're providing us. So I can understand the problems that we face. So that was one of the key problems that we have always faced till March of this year. Now we have access to capital at least to help us grow for the foreseeable future right now. The second thing has been since we were working in a regulated environment, so there were frequent changes that needed to be done in the infrastructure in our processes to adhere to upcoming guidelines of RBI that used to come that comes at very regular pace, I would say. So all these things go away once we become a regulated entity. That is something we are striving for. But since we are not regulated, but we work in that regulated space, there are a lot of tech changes, process changes that need to be done at a very frequent pace to ensure that we are adhering to the guidelines. I think that has also been a major challenge, I would say, because no one had a clear picture of what is right and what is wrong. We had to take opinions of consultants, we had to take opinions of our lenders, legal advisors, we had to take opinions of our legal advisors and come to a solution which we believe is that, okay, regulator will be fine with it. Since that was the case, so there were frequent changes that needed to be done. With the DLG guidelines coming in, I think everyone is going to have a very clear picture of what should be done and what should not be done. I think that is going to take away a lot of the headaches that are inherent in our model. The third thing I would say is that when we started the business, we had imagined it to be a very, how would I say, a very tech focused company. Uh, but the lending business in India, I think, is a more manpower led company. I think we have tech which ensures that everything runs smoothly, the customer experience is good, the institute experience is good, but still a large manpower is required. So in India, since the penetration is low and the type of credit data that is available on customers are low, in India it is still going to be a manpower heavy and tech enabled business. It will not be only a tech company that can work in the credit business. That's my belief. There are many companies which have been successful in building a completely tech focused thing, but that was a transition which we needed to do. We had to understand that uh, we are going to have a large manpower that is going to work here rather than just building tech products which can ensure that the other things are taken care of. So that is something that we needed to wrap our head around, I guess. So these three things were the key challenges or takeaways out of I think a startup journey is going to be a very is a journey that is going to have its own ups and downs. I think you need to have a very good core set of people that can support you through that period, which will ensure that you are able to go through those periods and come out at the other end a winner, I would say. And the second thing is that people need to have patience. And India is a jugaad country. I think we need to have that also when we are thinking of starters, that there will be times where capital will be constrained. There will be times when people are going to be constrained. There are many times where any of these factors will going to be constrained. Then at that point of time, we just have to be patient and determine that okay, we want to achieve that and figure out a solution which ensures that those constraints are in a way taken away. I think and an enormous amount of patience and determination is required to go through this journey, I would say.